Analyze and record transaction for merchandise purchase using the perpetual system. And so we're going to go through what the perpetual system looks like. And so there's these issues of cash discounts. We're going to first assess without cash discounts, but many times companies will give you a discount if you pay with cash up front. And we'll talk about how to account for that soon. But if there's no discount, what's the journal entry? It's just debit merchandise inventory, credit cash. Why? Because cash is an asset. So if we credit it, it reduces the cash and we trade hands for another asset account. What does that mean? It means that we're not expensing the inventory right when we purchase it, right? Remember, inventory is not an expense account. We wait until we sell the inventory to expense it. Make sure that makes sense. If it doesn't, ask me questions. Let's drill it. And so in Google Sheets, if I want to do the journal entry for purchases, inventory without discount, we just debit. Debit's always on the left, right? Debit means left, merchandise inventory. And then we credit cash, always on the right. And the 500s would equal each other. That's it. Remember, this is an asset account. Both are asset accounts. How does this affect the accounting equation? That's a question for the class. What happens to the accounting equation here?
You're just moving stuff around on the same side so it doesn't affect the balance of the equation, right?
Correct, 100%. Great job. Right, no impact to the accounting equation. Our assets increased and decreased. Awesome. Good job. Okay. So generally, when we're talking about these inventory operations, we're thinking of large companies, right? A small company is not going to hire an accountant. They don't need them. We're talking about companies that make over $1 million a year, or when you start hiring personal accountants to do anything but taxes, anything outside of taxes. And so the credit terms, let's see. Generally, when you're selling that kind of volume or that amount of dollars, you are going to offer credit terms to your customers. And so we're going to have a credit period and a discount period, because at the end of the day, we want to collect cash. I'm going to tell you right now, the worst thing you can do from a business perspective is not collect cash, right? If we don't get cash, we are in trouble. So we can make all the sales we want on credit, but if we can't collect at the end of the day, we're in trouble. So what a lot of companies do will then offer a discount if you pay cash up front. So we'll say, hey, we'll give you 30 days to pay this, but if you pay within 3, I'll give you a 5% discount. And so there's all this time, there's this time lapse that we have to worry about. So this arrow shows time. On the invoice, you'll have an invoice period. Normally it's called net 30. Normally it's within 30 days, you have to pay this invoice. So also known as net 30. And then they'll say, hey, within maybe 10 days, we'll give you a 2% discount if you pay within 10 days. Otherwise, you have a credit period of 30 days for the net 30. I mean, it's due, the invoice is due in 30 days. And so you can see here, the amount due is in the discount period, it would be the invoice price minus the discount. But if it's after the discount period, it would be the full invoice amount. And so this is what it would look like on an invoice. I've written invoice was like this. If I want to collect cash up front, I would say you have a 210 with a net 30. You're going to have to learn this language. 210 with a net 30. That means a 2% discount within 10 days. And then you have to pay the full amount within 30 days. So if you pay after the first 10 days, you don't get the 2% discount anymore. We can phrase this any kind of way. You could say a 5.5 with a net 60. Right, a 5.5 with a net 60. What would that mean?
So if someone pays a partial invoice, how would they put the discount?
We're not going to worry about partial invoices here in this class, but if they, we generally wouldn't allow that. Generally, contractually, if you paid like half the invoice in the first few days, I wouldn't allow that to become the customer to get the discount. Legally, right, the fun thing about business law and accounting is at the end of the day, anything can happen with transactions. So you brought up an interesting point. is you could have in the contract, hey, you could pay a partial amount in the first few days and we'll still give you the discount for the partial amount. It'd probably overcomplicate your transaction and you'd need to proportion it out. We're not going to go over that in this class, but just know you can structure a transaction in any way, right? So good point. So what happens if the customer takes a discount? So if they purchase, so let's say they purchase with accounts payable, and then they pay it with a discount. And so I'll put that here. And we'll say, what happens if we do it with the discount? And the discount will be the 210 and 30. So we're going to say same initial journal entry, except instead of cash now, we have accounts payable because the customer is paying on credit, right? We're saying we're going to purchase our inventory, and then we're going to put it on our credit. Question here, who am I in this transaction? Am I selling inventory or buying inventory? I'm buying it, right? So always be careful. That's a really good to try to grapple with this, because we always have to ask, am I buying or selling in any transaction, right? So make sure that you're reminding yourself, if our inventory is increasing and our liabilities are increasing or our cash is decreasing, then we're purchasing something, right? We might have the intent to sell it later, but that's not the substance of this transaction. So we purchased it, and then this is what the invoice looks like. I'm not going to really test you on what an invoice looks like, so don't stress about it. But then we say, hey, this looks like a pretty good deal to get a 2% discount. So what's our next journal entry? Our journal entry would be, let's say we pay it within the discount period. We're going to payable. We're going to reduce our accounts payable by the full amount because we're paying for it. And then our merchandise inventory is going to decrease by the discount. So what's our discount? 500 times 0.02, that's $10. So how much cash are we paying? 490, right? Because we received a $10 discount. We paid it earlier. How does this affect the accounting equation, a balance sheet? Well, our inventory value actually goes down. Why is this? You might ask yourself, well, I got a discount. That's a good thing. Why did the value of my inventory go down? It's based off one of the principles. What principle is this? We had a few principles in the first few classes, right? We had the monetary assumption, the monetary unit principle. We had the going concern principle. We had historical cost principle. Which is this related to? Account for assets at the cost we pay for them, right? We account for them for what we paid historically. Here, we're only paying $490, right? So our inventory has to be worth $490. And we can see here, if we debit our merchandise inventory 500 and credit it 10, it'll equal the cash we paid for it. Awesome. So everything that we do in accounting ties back to those principles, which is why I know theoretically they might seem vague or not that helpful, but they're actually extremely helpful when you go back to the accounting. It makes you understand why we're doing it. And so you can see here, this is what it looks like. Our merchandise inventory would be 500. We'd reduce it for the 10. It'd be worth the 490. Our cash would decrease 490, and we'd no longer have accounts payable. What does it look like after the discount period? We just don't take the discount period. We just don't take the discount. So if they did it after the first 10 days, we would just say accounts payable, cash, and it would be the 500. 500. That's it. We don't get the discount, we pay cash for and then we no longer owe the liability, which I put up over here. Yeah, good questions though, right? A lot of accounting is just staying organized. And is this tough for you? Trust me, I was the least organized person in the world before I did accounting. I was a musician. I owned a recording studio. You think I'm organized? I wasn't. This will help you get organized. So make sure you're just keeping track, right? You have to know, hey, here's my journal entries, and here's my T accounts, so I can track my journal entries. If you say, hey, I'm not an organized person, we'll get over it. You just be organized. You can do it. Just look at it as a puzzle or a game, right? This is with returns and allowances. So purchase return and purchase allowance. So you can see this is why personally I don't like running inventory-based businesses, because people can return the inventory, right? People can not pay me on credit. People can, you could still do a great job. People make a lot of money with inventory-based businesses, but it's why it makes it more complex in my opinion. So we could return our purchases if we purchase the assets, or vice versa. If we are selling them, we have to have a reserve for what we've sold. We're going to look at it from a purchase return. Please, please, please don't get confused with the difference between a purchase allowance and a return allowance. If it's a purchase allowance, that means that's something that I'm the purchaser, right? If it's a return, it means I'm selling it. So always try to keep these buckets off. Am I buying the asset or am I selling it? Do I have a right to return some of the assets I've received? Or does my customer have a right? Right? Keep that different in your head. So let's go through purchase returns and purchase allowance. So purchase return means that we can return it to the purchaser. Purchase allowance means there might be a reduction in price based off of the unacceptable merchandise. So here we're saying on November 5th, we issue they issue a $30 memorandum, debit memorandum, which we might just call like a customer credit. This is just terminology. Don't get hung up on the debit memorandum, for an allowance from Trex for defective merchandise. So we're saying here that, hey, we got a bunch of merchandise and we're not happy with it all. That's all. Like, hey, this is messy. It's not, we purchased $500 in headphones and a few of them aren't working. So who we purchased from, our seller, told us, hey, you don't have to return it. We're just going to give you $30 back. You just don't owe us $30 on your next invoice. So for the purchase allowance, we'll just have our accounts payable. Accounts payable is a liability, right? So we're going to reduce it by the customer credit we're getting. And then we're going to have to reduce our inventory by the same amount because of the historical cost principle, right? We're paying less for it. What about a return? Returns get a little more complex. And so we're going to go through these. Let's see. So we'll have to start being organized, right? Track everything. So let's track the dates. We'll go June 1st. On June 1st, we purchased merchandise. Nice. Of 250. We also have a 210, 10, and 60. What does that mean? We get a 2% discount in 10 days, but we owe the total invoice in 60 days. We have accounts payable of 250. On June 3rd, we return $50 of the goods. What does that mean? So June 3rd, we do our return. We'll reduce our accounts payable by the 50 of the returns. And then we're going to reduce our inventory by the 50 because we no longer have it, right? We don't owe the money. We're just saying, hey, we're giving this back. We don't like it. On June 11th, we then take the discount. Why can we take the discount? Let's see. We're saying that it's on the 10th day. So we got it on the 1st, and we're saying the 10th day is the 11th. And so we'll take the discount, but we only get the discount on the remaining goods. That's where we have to stay organized. For accounts payable, we're going to reduce it. What's our remaining accounts payable? It's the 250 minus the 50. Merchandise inventory will have to be reduced by the discount. 0.02, that's the 4. And then our cash, what we're paying for it is the accounts payable minus the inventory discount. Does this make sense? Awesome. So we're going to make it even more complex now. And it sounds more complex than it is, but there's this concept of what is included in inventory cost, right? And in theory, it's whatever we paid for the inventory, whatever it cost for us to bring the inventory to sellable position. Same thing with all assets. The cost of an asset is everything that we paid for the asset to be brought to workable condition. That seems simple, but there's a lot of costs associated with any given asset. So to keep it really complex, when we buy a house, if we bought the house and we had to make home improvements afterwards, is that included in the cost of the asset that we purchased? Or if I had to hire someone to legally help us buy the title of the home, is the real estate agent cost included? And so we can go into details about that later in assets, but I want you to think there's a lot more to this for every given asset than you would just think. It's not going to be something simple. And so we'll try to take it down a level for inventory, but good question here is, are delivery costs included in our asset cost? And so the question is, who pays the delivery costs? And who pays the delivery costs are based on what's called freight on board shipping point versus freight on board destination. That's what FOB stands for. So the question is, when do we own the goods? Do we own them at the point of shipping or at the point of destination? If I own them at the point of shipping, right, the shipping point, FOB shipping point, that means the shipping costs are part of my inventory. Because what that means is when the person sells me the goods, or when the company sells me the goods, I send my trucks to go pick it up. So it costs me extra money in order to bring those assets to my inventory or to my warehouse in order to be able to sell them. So it increases my inventory costs. If it's destination, it's just a shipping expense because I don't own those assets until they're at my destination. So make sure you memorize this. I used to remember this as destination. I'd remember this as shipping point. There's another word for shipping. There's another word that starts, a 4-letter word that starts with SHI, right? That means that it's bad, right? And so I'd call this that point for inventory for our customer, right? We don't want to have to pay for our truck to go pick up a bunch of inventory. We'd rather just have it delivered to us, right? We'd rather that included. So the shipping point is kind of unfavorable for us, that we have to go send our own trucks. That's how I remember it. You can remember it any way you want, but that's the easiest way for me. So you have to remember this chart. Who is going to pick up the inventory? If it's us, then we have to do FOB shipping point. Shipping point means it's unfavorable, right? It's unfavorable to us because we have to send our trucks and pick it up from the place of shipment. Or destination means it's sent to us and we might pay for the shipping, we might not. But if it's sent to us that way, it's not included in the cost of our inventory. So it's more favorable. The seller pays for those costs or sends it to us. Transportation costs, to your point, like we call that freight as well. We either include it in the cost of our inventory or we have it as a separate expense based on if it's shipping point or destination. And so if it's shipping point, and I'll put that here in your Google Sheets. Shipping point. If it's shipping point and destination. And so what if we just say freight is $75? Freight is 75 bucks. If it's shipping point, we'll have merchandise inventory. People just call it inventory, just so you know. If I'm just going to call it inventory, merchandise is not that commonly used. Cash is going to be 75. If it's destination, but we still have to pay for it, it'll be shipping expense. 75. That's if we pay cash. How is this different? This affects our margins and our income, right? If I look at my company and I use shipping point, my cost of goods sold goes up, which will decrease my profit margin, right? Because revenue minus cost of goods sold is our profit margin. Gross margin minus our expenses is our net income. If I do destination, my expenses goes up. So my gross margin is protected, but my income isn't protected. The same net impact happens to net income. So realize this is what companies can do to throw you off, right? A company could theoretically do a destination expense and have a negative net income, but show a positive gross profit. And so use these skills to think critically whenever you're making an investment decision. Ask yourself, hey, is everything included in this cost? And so this is what it might look like for a total net cost of merchandise purchases. This might just be a report you might run, right? Hey, here's all of our invoiced costs minus all our discounts and returns, plus whatever cost for our transportation is going to equal our cost of merchandise purchases. Just memorize, try another formula to memorize. And so we kind of went through these journal entries. I can go through them after class if we want to do more practice together. Well, let me know. Do you guys, what's better for you? Do we want to go through this example together, or is it easier for you to go through it yourself? Feel free to put in the chat. Whatever is most helpful.